Next, in this big picture analysis, we're going to look at the dollar and the euro. Of course, we look at both of those because the euro is 57% of the dollar index. So you really have to look at both to get a good handle on the analysis. Let's switch over to the monthly chart, looking here back all the way to the year 2000. And it's always important to me to do a little teaching that I'll do right now. And you can see that the harmonic families that we're looking at in here are the time frames for those are 76 months on the longest ones. The most dominant, the intermediate, is 38 months, and then 19 months on the minor cycle. There are 4 minor cycles that make up the dominant cycle that's in there, and the intermediate is exactly half, as you can see. Let's really look at how those align. It's just absolutely amazing when you look at that. Look at the big decline that occurred right over here as Greenspan killed the dollar in here. And of course, gold went up in a huge way, like 4 times during that period. And here you could see the half cycles right there. Each of those lined up just beautifully. And then you could see the quarter cycles, the way that they come in there. Quarter cycle, that's where they line up here. And when you get into periods where there's nesting, even at the end of the intermediate, the halfway point, you get some bigger declines. And when you get to where all 3 of them are moving down together is where you get usually the biggest declines. That's when the money flows are coming out the most. As you can see in here, this would be the inverse time when the euro would probably be moving up the most during those yellow areas, which are the periods of risk. You can note over here the biggest period of risk that we see is way out over here in 2027. So in the meantime, there are problems here when I look at this chart. Also note the inverted head and shoulders that formed in there and projected up to this target right there, which was just absolutely beautiful. So important, you can go to askSlim.com, go to our workshop page, and watch a free video there. You'll learn more about the analysis that we do. So let's look at where we are right now. The market last year, the dollar market, moved down right in here, and that low was a little bit early, but not too bad. And now the market moved up. Now, a little bit of a lesson in that is why is this decline not still part of this cycle? And the reason for that is the shape of it. The amount of advance was absolutely perfect. The upward turn right up over here in the reversal scalp gave you positive momentum, and that really declares that was this rising phase, or these 2 rising phases going on. Now, if that big upward energy from the dominant cycle was still pushing on the upside, it would not have failed here in this resistance. That, by the way, the top of that upside move was around 107.35. We were looking for 108 as the high for the year, so that was pretty good. So now what we're looking for is the euro to give some sense to this analysis, as we'll look at that in a moment. But we're projecting that the euro monthly trough, in other words, the euro is likely to fall into Q3 of this year all the way into Q1 of 25. That means that there's likely to be a rally right in here. However, there's a however. When I look at the intermediate cycles on the weekly chart, they are pointing to a trough or a decline, this decline that it's in right now, to continue out into April. So we're looking for a further decline out over here, get below this low here at 100.6, and then make a bottom in here out in some point in April, and then get an upside move into this resistance area. So we're going to look for a rally maybe into Q3 up to that 103.5, 104 area, outside 104.80 is what that looks like, and then be moving down again. So with the euro monthly trough due in Q3 to Q1, that means that there's a rally over here in Q3 to Q1, down over here into April, up over here. And for this rally to come, it would mean interest rates maybe have to be rising a little bit in there probably to get that. And then there's an issue for how far it will fall right over here into 2025, and then out over here into 2027. Right now, this downward turn right over here on the reversal scout is declaring that this advance is over with, and we are now in declining phases in here. That could only happen, as I said, if this had already turned down. In other words, the dollar is in a lot of trouble for a number of years. Every rally in here through all of this 24, 25, 26 should all be false and likely be moving to the downside in some significant way. So this rally and this decline, breaking the 78.6% this early, assuming this analysis is correct, is the worst we have seen in decades. We have not seen a rally in the dollar that only lasted 3 or 4 months and came down and took out the 78.6%. That is bad. Again, it's probably going to come down more into early part of the year, try to rally, and then come down again. If it breaks the cycle low at 99.578, it's extremely negative. Getting down over here warns under the 78.6 that the left-hand translation has formed. Getting under 99.578 puts the final nail in the coffin, and the dollar would be moving down significantly. Next trough, mid-25, followed by major trough out here in the beginning part of 2027, where this time frame to hold. The dollar looks like it's in a lot of trouble. And there will be rallies. There will be times when interest rates are ticking up, and there will be times when the dollar looks better. But overall, this is really bad. It would really take a rally that takes it back up close to 108 to repair this, what looks like very negative conditions for the dollar. Now, how good are these? How good are these cycles? Take a look right over here, where it bottomed. That was the positive period for the dollar. Look where it bottomed here. Positive for the dollar, positive for the dollar, positive for the dollar, but failed already. That's really, really bad, and that really looks like a lot of trouble right over there. It would have to turn back up, get this reversal scout turned back up for us to believe anything different was occurring in here. Bad conditions. Let's just switch over now and look at the euro, which if we're looking for the decline or stuff to be, the market to be in trouble for the dollar, then we're going to have to be bullish in the euro. EUR/USD is what we're looking at. And you can see we talked about the dollar falling out into 2027. This, you can see, is the rally out into 2027 that we have projected right over there. This looks like this choppy area where the dollar, comes down. This has a little bit more rally. Then the euro comes down, and the dollar does a little bit better right in here as this comes down. So a lot of chop expected here in this year, and then eventually the dollar's coming, and sometime in 25 is really where this upside turn is likely to come in the euro. So that means we're looking for a range in here in the euro currency over this next year, and that range probably is somewhere right out over here. That's about 102. The peak over here is around 113. That's a pretty wide range. You can see that we're expecting a very choppy dollar if the range is going to be this wide in the euro currency. So again, the best time for the euro, the worst time for the dollar, really looks like it comes starting in 2025 right there. And in the meantime, we think we're going to see a lot of chop looking at that. Let's just go back and peek at the dollar one more time here so that you can see, and you can see right there that that period where we expect the dollar to decline starting here in 25 in some significant way out into 27 is where that euro currency looks like its best. And again, a big choppy period right under here, probably getting down sometime this year under that 100 mark or close to that, and probably getting up here to about, we'll just call it 104 or so is the range. 100 to 104 this year. And if it gets under 99.578, it's really a bad occurrence for the dollar.